crude oil price has relentlessly trended lower all year to an imaginably low price of $37 of just a few days ago, falling from $100 a year ago. The severe bear market has not only caught many market commentators off guard, but has also had a devastating impact on several major economies that are heavily reliant on high oil prices, such as Russia and the Gulf states, and other emerging markets reliant on the energy sector tax revenues to finance state spending. And of course there's Britain's very own Scotland, that a year ago was actually toying with the idea of committing social and economic suicide, i.e. the independence referendum. It's only a year ago that the S&P fanatics were busy galvanizing the gullible masses with a stream of heart-tugging propaganda into convincing them to effectively vote to commit suicide by leaving the UK, which I liberally warned of the consequences of in dozens of articles and several videos at the time of the catastrophe that lay in store for Scotland, which will be at the polar opposite of the S&P's propaganda, the reality of which would literally include the breakup of first an independent Scotland and then the remaining UK. Nothing illustrates the magnitude of the potential catastrophe that was the S&P's economic program for an independent Scotland than its reliance on an oil price well north of $100 a barrel, so as to turn Scotland into the promised land of milk and honey. The picture being painted was of an independent Scotland, i.e. IS, of a paradise on earth, not that far removed from reality than that which the Syrian IS paints for the world's gullible Muslims that crave a fast track to paradise. The problem with S&P economic propaganda is that it was based on an oil price, as I've said, over $100 per barrel. However, a sub $50 price does not just mean that an independent Scotland would have made about half the forecast tax revenues, i.e. 3.5 to 5 billion. Instead, the reality is that an independent Scotland today would be forced to bear the costs of supporting a collapsing oil industry, just as the UK government has stepped in to support the Scottish oil industry to the tune of £1.5 billion. So an independent Scotland would today have a negative cash flow from the North Sea of about minus 1.5 billion a year, rather than the fantasy figures of 11 billion. That illustrates the magnitude of the catastrophe that Scotland only just missed by a whisker if they had fallen for S&P nationalist propaganda. Whilst elsewhere in the world, the oil price collapse of 2015 has forced the likes of Tsar Putin to rein in his Ukraine and Eastern European military ambitions, which all year have remained stuck in a holding pattern in Ukraine after last year's land grab that few saw coming, but that which I warned of at the very start of what lay in store for the people of Ukraine. Just as an independent Scotland, Russia requires an oil price north of about $110 a barrel to maintain its state finances, and for every $1 below 110, Russia loses an estimated $2 billion in tax revenue. With crude oil currently trading below $1.50, that's a huge revenue loss of well over 120 billion per year that has plunged the Russian economy into recession, with the Russian economy now looking set to contract by as much as 4%. That is also bearing the costs of the sanctions as a consequence of the Ukraine war that is costing Russia at least 1% of GDP. So it's no wonder that Tsar Putin has pressed the pause button on the Ukraine war, to probably wait until the oil price is recovered back to around $100, towards which Russia has little control over bringing about. In fact, the budgets of virtually every major oil producer require an oil price north of $60 just to break even, with several such as Russia requiring a $100 plus break-even oil price, and what is in large part sparking the economic migration of tens and thousands of a month out of African oil producers such as Nigeria, whose government actually requires an oil price of $1.20 to break even. Whilst the oil producers and exporters are hurting, the oil consumers and importers are experiencing an oil price cut bonanza as the drop in price amounts to an effective transfer of wealth from oil producers to consumers to the tune of at least $1 trillion per year, a huge economic stimulus for the likes of the US and UK and Europe and every other major oil importer that has probably saved the Eurozone economy from re-entering recession this year. Fundamentals of a slowing China, Iran about to ramp up its production, and Saudi Arabia's war on the US oil shale industry ensures that the crude oil price is unlikely to spark a return to $100 anytime soon, and more likely to probably remain stuck in a trading range until Saudi Arabia has succeeded in killing off the competition. My oil price forecast for 2015 as a component analysis of the US dollar analysis of 14th December 2014 expected the oil price to trend lower into mid-2015, targeting a drop from the then approximately $60 to a target low price of $36. The crude oil price subsequently did trend slowly lower towards its mid-year target of $36 by actually putting in a bottom just a few days ago at $37.75, which now implies that the oil price has probably bottomed. Therefore, this analysis will seek to determine what comes next for the oil price for the remainder of 2015 and at least into mid-2016. Technical analysis, including trend analysis and Elliott wave theory, are collectively pointing towards the crude oil price remaining stuck in a bottom scraping trading range for several years of between $64 and $40 with occasional temporary spikes outside of the range, probably more to the downside than the upside. The crude oil price has continued to exhibit a strong inverse relationship to the US dollar. Apart from the most recent price action, which shows relative crude oil price strength, my long-standing forecast for the US dollar is to marginally weaken into the end of this year from the current level of 96 towards about 93. A marginally weaker US dollar should therefore be supportive of the crude oil price, therefore implying a trend towards the upper end of its price range of around $64, as well as now probably holding the bottom of the trading range at $40 on any corrections this year. Therefore, whilst it is highly probable that my original forecast low of $36 has now been achieved at $37.75, the overriding message from this analysis is that the crude oil price looks set to enter into a prolonged trading range of approximately $64 to $40 for the next 12 months. Therefore, my forecast conclusion is for the crude oil price to trend higher in the immediate future towards the upper end of the trading range before turning lower and to remain within this trading range for another year. The range could also exhibit very short-term spikes to outside of this range, i.e. to as high as $70 on the upside and as low as $30 on the downside, though I would expect downward price spikes to be far more probable than breaks above $64. After all, crude oil price is coming out of a bear market. In terms of investing, with the sustained low oil price oscillating within a tight trading range for at least another year, then this suggests that the oil sector is going to continue to contract, with many players going bust due to unserviceable debt mountains built up during the boom years. Therefore, it's going to be difficult to find the few golden nuggets that buck the trend amongst all of the junk out there, so it's probably better to wait a year or so for the dust to settle than take a gamble today. However, if one does want to invest, then accumulating positions at the bottom of the trading range is probably the best strategy. For the implications for the general stock market indices, then ensure you're subscribed to this YouTube channel for my next in-depth analysis and concluding trend forecast for the stock.